Hello there, I welcome you all to this webinar which is specifically designed for the purpose of understanding the concept of swing trading and its various facets. We'll be trying to understand what is swing trading, what are the various functionalities which are associated with it, and we'll also devise few strategies, and we'll end the webinar by giving you a demo of how do we spot swing trades on the chart. Hi there, my name is Hitesh. I welcome you all to this webinar. So let's begin our discussion. Understanding that as a kid, what used to be our favorite game? It had to be swing. There can hardly be anyone who didn't like swing. I mean, everyone would wait in the queue just to be a part of this game. To and fro, got the best out of it. The energies were strong and you would make the best out of it. So the concept of swing trading is like that game of swing in the market. The idea is to capture that movement or capture at least one movement out of the multiple movements which happen in the swing or in the zone. So just to reiterate again, the topic which we'll be covering today is actually swing trading. We'll try to focus on specifically swing trading. Why swing trading? How was swing trading such an integral part of any trading system or anyone who wants to be a long-term trader? Through this webinar, we'll try and understand what are swing trades, who is a swing trader, how to spot a swing trade, how to choose stock for swing trading, three most important and the most viable swing trading strategies, advantages of swing trading, disadvantages of swing trading or limitations of swing trading, should we say that, capital required for swing trading. It is important for us to understand that how much money do I need to be a profitable swing trader. We also need to keep in mind the other expenses which are associated with the swing trading. So we'll try to figure out what are those specific expenses. Should we be doing swing trading in penny stocks or not? This is actually a question which has been asked to us many times. So we try to dissect and break that. Is it relevant or is it important, or can we ignore swing trading on penny stocks? Importance of stop loss while doing swing trading. Do you do any kind of trading? If you want to have a successful career, you have to learn the art of keeping a stop loss or learn the art of exiting the trade when you know that you're not right. So let us begin our discussion with our first topic, and it is what is swing trading. So I'll go quote unquote, according to Wikipedia, swing trading is a speculative trading activity or strategy in financial market where a tradable asset is held for one or more days in an effort to profit from price change or swings. So I'll break down this definition. So the idea behind swing trading is that the market moves from one place to another. It either comes back or keeps going up. But there's always a zigzag movement, and sometimes the market is stuck in a range. Sometimes the market is trending, but it's trending within a zone, and every movement up or down is a swing. The idea behind swing trading is to capture that one move from either bottom to top or top to bottom, and that is the whole fun around swing trading. And the holding period depends on how fast the market is or how volatile the market is. If it's a very volatile market, you could be getting a swing trades frequently. If it's a slow moving or if it's a sideways market, the number of trades are lesser in number, but it gives you better and more qualified trades. If you look at this chart, I have drawn two parallel lines, and in which we see that mountain kind of structure is drawn, and I have plotted 5 swing places. So these swing places are the movements of prices from bottom to top, top to bottom, bottom to top, top to bottom, bottom to top. So these are 5 movements which has happened in the market within that parallel zone. Each and every movement is a specific swing. So the idea behind the swing trading is to capture that one move. You don't necessarily need to capture all the move. No one is able to capture all the move. If you can capture 2, 3, 4 moves out of 7, 8 moves which happen in the market, you're doing a very good job in the market. So the idea behind the concept of swing trading is that you have to pick trades when you are positively sure enough that the swing looks to be in place and I should be able to capture it, enter the market, capture the trade, get out when a trade is finished. So that is the whole facet of swing trading. Again, this is how the market looks like. The market, even if it has to go up, doesn't go like this. It always goes up in a zigzag pattern, and every zigzag brings a swing along with it. I'll tell you one simple thing. If the market is trending up, look for those trends which have swing up. The swing down will be smaller because once the market is trending in a certain direction, the opposite direction moves are smaller compared to the directional moves. Or for a good swing trade to be taken, always look for a directional move and try to capture the movement in that direction. So sometimes what happens, even if you are wrong, your losses are not big. You lose only small amount of money. So that is the rationale behind trading with the direction in a zigzag manner, gives you in and out. Take those trades and make money out of it. Now, who is a swing trader? We understood what exactly is swing trading, but what qualifies to be a swing trader? So to be considered a swing trader, One needs to have strong grasp of technical analysis. Technical knowledge is of prime importance if you're a swing trader. If you are an investor and looking to hold it for a long period of time, looking just at the fundamental picture, swing trader might prove to be a difficult thing for you. So to be a successful trader or a swing trader, you need to have a very good and a very nice understanding of the technical analysis. The next important thing, one needs to be good with price action. What is price action? Let us understand that first. Price action is the action which happens around the current price, or the buying or selling which happens around the current price. Say for example, if someone is buying in the market and is buying with big volumes and is hitting whatever offers are coming in the market, which means, what do we understand? There is a strong buying momentum in the market. On the other side, if someone is hitting the market and blowing off any bids which are there in the market, what do we understand? There is a strong selling pressure. Someone must be buying at a specific time of the day. We could be seeing that the number of bidders are more than number of sellers in the market. That is a simple functionality of price action. If someone is able to have a grasp of price action, understand that what could be the likely move in the market based on the current price action, it will be actually easier for him to be a good swing trader. A very good awareness of price levels are important. It's all good that you understand technical analysis. It's all good you understand the price action. But until unless you know the price levels on the chart or the price levels of product which you're trading, it will not be easy for you to be a swing trader. You just can't look at the chart and say, I'll take a swing trade. You need to see what happened around the price level. Say something is trading around 200 rupees and you think it's a good level. So there must be a rationale or logic behind it. So we must be able to understand what is the rationale, what's the logic, what's happening around the price levels. So that is what a good swing trader does. So to be a good swing trader, one needs to have a decent understanding of price action, technical analysis, plus remembering the price levels is also very important. So in a way, swing trading sometimes can also be called as a full-time job. You need to be active in the market to be able to get a grasp of everything. Now, how does one go about spotting a swing trade? We've understood what is swing trading, we've understood who is a swing trader, but now we'll try to understand how does one spot a swing trade. So spotting a swing trade is an art in itself. So the following are some of the factors which have to be considered. The market needs to be in a channel swing. So for a trade, or for us to be able to take a swing trade, there has to be a certain channel within which the market is. It just can't be randomly going up. It sometimes goes to 50, 100, 150, 40, 30. No, that's not how it works. The market generally moves in a channel, and if you're able to spot the channel well, it gives you very good swing trading opportunities in the market. The swing levels have to be of significance. Just testing a level once doesn't make it an important levels. It has to be tested many times. There has to be a very good price action, buying, selling around it for it to be qualified as a swing level or a point for a swing trade. The risk to reward ratio is of prime importance. You can't be taking a trade saying that my reward is only 5 rupees, but the risk which I have to endure in this rupees 10. No, that's not a good risk to reward strategies, because to cover once hit stop loss, you'll have to make 3 to 4 times profit to be able to cover just the loss which you have had the capital. So good risk to reward trades become very important if you want to be a very good swing traders. And the ongoing and the current momentum is also very important. Like I told you initially in our discussion also, take the swing trades in the direction of the move or in the direction of the market. Try avoiding taking opposite swing trades. If the market is stuck in a straight channel, it's all well and good to take buy and sell signal. But if the market is trending in a certain direction, but we see zigzag patterns, so every dip becomes an opportunity to buy. Not that whenever the market goes up, you have to sell it. No, once the market is going up, look for dips to buy and capture the swing moves accordingly. So these 4 important factors are very important if you want to trade a swing trade. The first is the market needs to be in a trend or a channel. You don't need a market which is haywire. The swing levels have to be of significance, which means they must have been tested 3, 4, 5, 6 times. The risk to reward ratio is of prime importance if you want to be a swing trader, and the momentum also needs to be in the direction of the market if you want to be a good swing trader. Now, how does one choose the stock for swing trading? Now that having understood that what are the important facets of swing trading, now the next step which comes to our heart is that how do I choose a stock for the purpose of swing trading? So as we are all aware that the Indian equity market has more than 5,000 stocks listed on the stock exchange. It's not just 50, 60, 100, 200. We have more than 5,000 stock listed. So it is impossible for us to be able to track all the stocks or trade all the stocks I'm pretty sure not many people in the country who are very active and have been trading for a long time would be knowing the names of those 5,000 stocks. So how does one go about spotting the asset or the stock which I want to trade for swing trading? So I have personally devised a checklist of 3 steps which will be useful for you if you want to shortlist or freeze on the stocks which you want to be using for the purpose of swing trading. Let us understand more in detail about these 3 important factors. So the first point is volume. Why is volume so important? Why is specifically more important for new traders? Why does everyone keep about that only when there's a volume in the market, any technical factors, any technical indicators hold significance? Market without volume is of no use. Why is it so important? This is mainly because if the price movement has happened from 100 to 102 rupees, there's only 2 rupees price movement, there's nothing much to choose there. But look at the volume which would have happened there. If the move has happened with huge volumes, I'm saying lakhs and lakhs of shares have traded in that much of stock prices, which means the move has some significance. Those become important levels to look forward to. But if the market moves from 100 to 102 with very thin volumes or very less volumes, that move doesn't hold much significance and the level becomes irrelevant there. And sometimes what happens when you're a new trader in the market, what you're trying to do, you're looking to buy something cheap and try to maximize out of it. That is not the right strategy. Look out for those stocks which are at the price which is within your budget, but they must also have significant volume associated with it. Don't trade those stocks if you are a new trader in the market which have thin volume. Always have stocks with higher volume. So sometimes what happens, you might be wrong in the trade, but if you have decent amount of volume trading in the market, it will help you in exiting a wrong trade and look for new opportunities in the market. So it is advised to choose stocks with high trading volume and high standing volume. Standing volume is also important because sometimes you just want to hit the market, but if there's no standing volume or there's no decent size of standing volume, what will you hit? So high trading volume and high standing volume are first important criteria if you want to choose a stock for the purpose of swing trading. So the first factor which we have covered is volume. The second factor is the sectoral analysis. Now, just because a stock is a stock doesn't mean it behaves in the same way. Each and every stocks behave in a different way. Some stocks are very volatile by nature. Some stocks move in a sideways zone. Some stocks are normally trending by nature. So each and every stock has a different idea or different characteristics associated with it. The 5,000 companies which we talked about listed on stock exchange belong to a different sectors. There must be 30, 40, 50 sectors in the market, and each and every sector moves in a certain way. Certain sectors are seasonal by nature. Certain sectors behave the same way throughout the year. So we have to choose the sector which can be used for the purpose of swing trading. And sometimes what happens, every individual trader has his own trading style. Supposedly, if I am a trader who likes trending market, or if I'm a trader who likes a rangy market, or if I'm a trader who likes a very volatile market. So depending on one's trading style, they should choose a sector which would be suiting their personality of trading, so you don't get stuck in a sector or stuck in a trade not knowing what to do because that doesn't suit your trading style. So the 2 factors which I've understood so far is volume and sector analysis, and it is strictly advised if the stocks don't fall in these 2 criteria, they should not be a part of your watch list. What's the point having stocks and confusing yourself and randomly entering a trade which don't actually meet the style of your trading? And the third important factor, volatility. Volume, sector analysis and volatility. VSV factor. It's a triangular factor. For the 3 criteria are met, that asset becomes very good for your swing trading and it suits your personality and style also. So what is volatility? Volatility basically means the movement of share prices from one place to another. They should not be in a tight range. You don't want very tight range share prices. You want at least some movement in the share prices to be able to capture the swing trade. Some traders like the market which are volatile but they are in a tight range, which means they keep going up in zigzag pattern within that range. Some traders like higher range market and volatile market. So depending on the style of your trading, choose the stock which suits your personality. So it is personally advised by me, choose those stocks which fits your trading style. Do the ESP analysis, volume, sectoral and volatility analysis. If you find stocks which meet in that criteria, boom, you find the stock for your trading. Now the next point which I'll be talking about is the crux of this webinar. I'm going to be talking about the 3 best swing trading strategies. When I say best, what I'm trying to say, these strategies have been tested over a period of time and they have provided very good results. I personally use this strategy. I've been a trader for almost 13 years now. So let us jump and understand the strategies with the help of few examples. So the first strategy which I'm talking about is stuck in a range. I would want you to pay attention and understand the strategy, because the strategy can be understood with the help of chart very easily. The first strategy is called stuck in a range. So what is stuck in a range? Range is the zone within which the price is moving and the market is stuck in a range. So you want to take advantage of the swing levels within the range. So if you look at the left hand side of your screen, the market is actually in a bigger range and looks like there's a bullish momentum kicking in the market. But once the market comes down, and you can see the market is getting stuck in a range, which means the market is not able to break out freely. Now, how does one know this has become a level of significance or this has become a level of swing? It is simple. First, the market at the start of the channel, the high was around the levels of 222-23 rupees. Then the market came down and it traded below the level of 200, around 195 levels, and then the market again went up and it traded around the levels of 220. So what does one do here? Look for candlestick patterns around it, because we know that 220 was the point which was recent high. Look out for opportunities which can be seen as opportunities of shorting in the market. Once the market gives you a signal, okay, I'm not going to break upside, take a short around that level and then wait for the market to come down to the level of support. Now the important thing to consider here is this: where do I put a stop loss? Have a little conservative stop loss. Don't have an exact pinpoint stop losses. Give little consideration, because within an intraday movement, sometimes market moves up by extra 1 or 2%. So you don't want to be stopped out when you're right. And how does one choose when to exit? Ideally, the target should be the low of the previous swing. But sometimes what happens, the market doesn't go all the way. So have your profit target slightly above that, maybe 2, 3, 4% above that, because you don't want to be right in the market, still not be able to make profit out of it. It is okay to lose 2 or 3 rupees of profit rather than losing the whole profit which you would have made out of it. So the stop losses have little conservative on the upside if you're shorting, or conservative on the downside if you're taking longs. And the profit target should be slightly below the swing levels, so you know that I know when to exit, and if the market is moving in my direction, I at least will have my profit booked. So this is the first example of stuck in a range strategy. The second example for same strategy, it is for the share price of Infosys. Now this is a very good example, because this channel gave you 4 to 5 trading opportunities. Let us jump and understand each and every trading opportunities. Once the market enters the channel, and when I say channel, I'm talking about those two parallel lines. The market goes up and trades around the levels of 1590 rupees. We see that the market has formed a high. Again, when it comes down, it doesn't break the low of the channel, which means what? The market is stuck in a range, and we are likely to see the market again getting stuck, going up, coming down in the range. So what you do is look out for buying opportunities once the candle formation has happened and you see 3 small green candles, which means what? There's a volume there and the market is not willing to come down. You can take your long and aim for the swing high, and swing high doesn't mean the exact level, slightly below it. Exit your positions. Look at the price action around it. Again, look for shorting opportunities. If you look at this way, the market has given you 1, 2, 3, 4, 5, 6 trading opportunities. In the last trading opportunity, it is possible you might have got stopped out by taking short. But if you're making money on the 4 to 5 opportunities, then it is okay to lose money on other trades, because you're never going to have 100% accuracy in the market. So stuck in the range, works in a channel, form the swing highs, swing lows, connect the dots and try to figure out trading opportunities. And if you want to be more specific with the trades you want to take, so don't take this in between trades, look out for exact swing highs and swing lows. Even doing that also, there were 1, 2, 3, 4 opportunities in the market. You could have entered longs, you could have entered shorts and made money on both the sides. So this is the power of rangy market. If you're able to capture the channel and understand the swing highs and swing lows, you can get a lot of trading opportunities in the market. And the third example comes from Titan Industries. This is even a better trade. Once the market again enters the zone, it forms a high and the market comes down and again goes exactly to the level of swing lows, which means what? There's the buying opportunities. If you're taken trade after the candlestick formation of bullishness, take a trade around the level of 1450. Keep your stop loss below the level of 1410 because that's slightly conservative. Your first immediate target will be below the lows of the previous high, which came to be around 1590 levels. So 130 rupees profits potential and 40 rupees loss only, which is a risk to reward ratio of 3:1, which is absolutely brilliant. Again, if you look at it, when the market came down, you took a long here and I told you keep a slightly conservative stop losses. Some people might have got stopped out, and if you had slightly conservative stop loss, you would have still be a part of the trade and capture the whole move from 1425 levels to 1600 levels. So this is the power of swing trading. depending on your risk appetite and slightly conservativeness in the stop loss gives you decent trading opportunities in the market. And the second trading style which I'll be talking about within the concept of swing trading, it is called catching the trend. Now trend is a friend, I mentioned you initially in our discussion also. So the idea is to capture the trend and to capture the swing moves in the direction of the trend. Now there are two important factors to consider here is that first of all, when you are trying to trade the trending market, always put a 50 period moving average because that moving average is generally not breached when the market is trending. So have that 50 moving average working for you, plot it on the chart, and I know I personally use 50 period exponential moving average, even simple moving average works the same way. So you can see when the market is going up in a certain direction, the up moves are longer than the down moves. Say if the up move is for 10 rupees, then the down move is only for 2 to 3 rupees. Again, if the up move is 15 rupees, then the down move is only 4 to 5 rupees. So we are trying to buy the dips here. Now you can't be buying all the dips. So the point is, which dip should I buy? So buy those dips which are very close to the moving average. Why? Because it will give you a very good risk to reward and your stop loss will be limited. It will be below the moving average line and for the candle to close there. Once the candle closes there, you get out of the trade and your trade is over. But if it doesn't do that, keep holding your trade and wait for the next swing on the upside and keep making gains out of it. So the first opportunity happened when the market crossed over the 50 period moving average and settled above that. Is when you knew that the market is getting out of the bearish momentum or the sideways momentum and we could be trending up in the market. So if you're taken long around the MA, your first the market kept drifting up and it actually gave a decent return of about 30% of the trade. Again, when the market went up, you might be thinking it's going one side, never goes that. It again came down, came near the level of moving average, again give you buying opportunities, gave you a profit of 20%. In the third instance, you would have got stopped out because the market came there, settled below the moving average and it looked like that the bearish momentum might kick in. But once again, when the market closed above the moving average, we saw higher moves coming in the market, which means the shorts got exhausted. All the shorts which got accumulated here, they were out of the market. So it gave you decent opportunities of buying again in the market. So in case of trending market, there are two important factors. First is the 50 period moving average and try to understand what is the likely movement or trend in the market. If the trend is upside, look for buying opportunities. And if the trend is downside, look for selling opportunities. And the second example for catching the trend procedure would be the Nifty 50 chart. This chart gives you even more obvious trades in the market. We don't even require the zigzag lines to be drawn here. The market is trending beautifully about 50 period moving average. It almost working like a trend line. That's how straight the moving average line is moving. As and when the market gave you an opportunity near the 50 period moving average, it gave you a swing trade. The market came near the swing lows, because when I say swing lows, the previous lows were around those levels. The market came around there, spent time there, made a bullish candle, gave you a trade, and we could see 4 trading opportunities which came in the market. So this is how trending market works. Once they start trending or drifting in certain direction, say if it's drifting up, look for buying opportunities on every dip. Say if it's drifting down, look for selling opportunities in every movement up towards the moving average. So 50 period moving average becomes a very important factor if you're using catching the trend as a procedure for this kind of swing trades. Now the third and the slightly difficult form of trading strategy if you're using swing trading is called against the grain. What is against the grain? If you look at any harvesting field or any farmland, the grain certainly go in one direction when the wind is blowing. But the idea is to take a trade which is opposite or against the trend, which is why this strategy has a slightly higher risk, but the reward potential is also decent and it gives you quick rewards. So let us understand first what is the strategy. So in the strategy, what happens just in case of trending market, the market say is going up. We see market going towards a high, coming towards MA, going up again, coming towards a MA. So sometimes what happens, quite a few traders miss out on trading opportunities initially, and they see that the market has again come towards the MA and started going up. And once the market reaches the swing high, they feel that the market is about to make newer high. Let me jump the wagon here. What happens there? Kaboom! The market comes down, catches them off guard, and they have no option but to book losses, and we see fresh short positions being initiated. The important thing here in this strategy is that don't be greedy about the profit. Don't think that the reversal has happened and I'll capture the move completely in direction. Just exit when you reach the recent swing lows and book your profit. Let us understand with the help of simple example. Now this is a chart which shows you that the market in general looks to be in a bullish momentum and the trend looks to be on the upside. But as and when the market reaches around the levels of 350 for the first time, we see market topping out and again coming near the 50 period exponential moving average. And again we see buying momentum, and this time when the market crosses 350, few of the bulls or few of the buyers in the market feel that we could be heading again towards a newer high. So they enter the long positions and they're right, the market goes slightly in their favor. But we see a massive red candle formation here which I have marked on the screen, and which is where your shorting opportunities comes. Take a short around this level, keep a stop loss above the high of the previous candle which we have seen here, which would be somewhere around 350, 355, you're short around 345, and target for the recent swing low which was around the level of 275. That becomes the first level of target, and that should be the target you should be aiming for. Don't look for anything bigger. So these are the kind of trades which are difficult to spot, and sometimes you get wrong in these trades also. But if you get these trades right, the risk to reward ratio is almost 1:8, 1:10. That kind of risk to reward ratio you get in these kind of trades. Why such a big risk to reward? Because you are preempting the move against the market trend or against the market psychology. And if you are right, which means you're rewarded in a higher way. Another example of this strategy is on the charts of Pidilite Industries. Again, if you see, I have drawn a trend line at this point and I have joined about 6 to 7 points. As and when the market came near the trend line, we see the buying momentum coming in the market and the buyers feel that they are in control of the market. But in the last instance, when you see this big red candle formation in the market, there is a certain level of indecisiveness when thinking that the market might not be willing to go higher. Previously, throughout the chart, we don't see this level of candle formation, but this is the first candle in which the size of the candle is almost the size of the previous red candle, which means what? The buying in the previous candle has been actually completely consumed, and we see more selling coming in the market. So you could be taking a trade once the market came around the trend line, take a short on that level, but the only factor is that the stop loss is slightly bigger. You need to have at least 80 to 100 rupees stop loss, but the reward here is almost 300 to 400 rupees. So this is slightly more courageous trade, but it's a trade nonetheless, and it gave you a risk to reward of again 1:3 in the market. So to be able to spot that kind of trading opportunities and to be able to take benefit from it is what the whole crux of swing trading is. So we have understood 3 strategies in the swing market, in the zone, basically stuck in a range, trending market, and against the grain strategies. And we understood with the help of 7 to 8 examples in the market. Now, having understood the whole premise of swing trading, let us understand what are the advantages or benefits of doing a swing trading. For starters, it gives you versatility. When I say versatility, what I'm trying to say is that to be a complete trader, you should be able to trade all kind of market. Small range market, big range market, trending market, volatile market, coming up and down, one side directional market. Each and every market type should be a part of repertoire. If you have that, you end up being a versatile and a complete trader. Second is identifying new trading opportunities. If you are a swing trader, you don't look for just mere small scalp or look for a large trade. You look for swing trades. You look to capture movements of both sides in the market. That is what swing trading gives you. Risk to reward ratio. Now, swing trading, the whole premise is based on the function of risk to reward ratio. If the risk to reward ratio is in your favor, you get very good trades, and when the trade is right, the reward is also very fruitful. And most importantly, it is a more focused and reliable approach. Why focused? Because you need to be on the screen, watch the price action, see the price movement, who is buying, who is selling, what kind of technical factors are working in the market. So it makes you more focused, and your approach is slightly more reliable because you know that at these levels the buying happens, at these levels selling happens. So what do we understand so far? Swing trading can't be learned in one go. You have to practice it to be able to perfect the art of swing trading. Once you take few trades and once you make few mistakes, and most importantly, if you learn from your mistakes, you are bound to be a better trader and a more complete trader. And everything which has advantages also will have limitations also. So the first is unpredictable. Sometimes what happens, you have taken a swing trade, you have kept your stop loss on the market, and the market is in a zone, but we get some overnight news. So what can that do? There's a good chance even your stop won't be triggered, and you would be losing much more than what you actually want to lose or you had planned to lose on that trade. So in that case, swing trading can sometimes become slightly unpredictable also. You need to be a slightly expertise. Why? Because you need to have technical knowledge, you need to understand price movement, you need to understand the price levels, you need to understand the price action also. So all these technicalities and important knowledge is of prime importance if you want to be a good swing trader. And it's a game of psychology. Sometimes what happens, certain traders need to have slightly more courage to be able to trade swing trading. It's all about how much courage you have, how much of willingness you have to be able to be a part of risky process. No doubt swing trading is slightly risky because you can be wrong and you could lose much more than what you want to lose. But it gives you a chance of making very good return on the investment which you make by taking a trade. So psychology, expert knowledge and unpredictability are the three limitations. I wouldn't call them exact limitations, it depends on trading style, but these are some of the limitations which could be faced while doing swing trading. Now the most important thing, how much money do I need? कितना पैसा चाहिए swing trading के लिए? What are the capital requirements for swing trading? It depends again on the price and the quantity of stocks you want to buy or sell or trade. Now supposedly I am buying something worth 100 rupees and I want to do swing trading with 20 shares only. Then the capital requirement will be only 2000 rupees. But if I am trading something like Reliance Industries and I want to trade say minimum clip of 100 shares itself, then the capital required for one trade would be about 2 lakh rupees if it's around 2000. If it goes up, you need more capital. So it depends on what price you are trading and how much of quantity of shares you're trading. But if you are someone new in the market, start with small amount. And when I say small amount, I don't mean 100, 200 rupees. Start with maybe 5,000 rupees, 10,000 rupees. By that logic, you'll be able to trade good shares also in a smaller quantity, learn from it, build your capital, and then go for the bigger game. Commission or the fee cost is also important. Every transaction which you do has a cost associated with it. It could be in the form of brokerage fees, it could be in the form of taxation to be paid over the trades. So all those factors need to be considered as a part of capital which is required for swing trading purpose. What are the other expenses which should be kept in mind, because these expenses are always or most of the time ignored, but we'll try to focus on this part also. The first is slippage. Sometimes what happens, you are in a volatile market, you have kept a stop loss, but the stop loss won't be triggered and you would be losing extra 2, 3, 4% per trade. So that actually becomes a part of extra expense. Let me give you a simple example. If you have bought say shares for 100 rupees, your profit target was 104 and your stop loss was 98 rupees, which means you were willing to take 2% risk. But for some reason the market spiked down and you had to cut your loss at 96.5, which means what? You have lost 3.5% as against 2% which you're willing to lose. Slippage is that factor or the cost which is incurred if your stop loss as planned is not triggered and you have to play slightly more to be out of the trade. Next is the taxation. The taxation policies can change from time to time. They're not always same. Whatever tax was charged about 10 years back is not the same anymore. Whatever income tax you paid 5 years back is not the same anymore. So this is again one cost factor which needs to be considered while doing the capital requirement for the purpose of swing trading. Software cost. Now this is very important factor which people don't talk about. If you are trading with sizable capital, you would want to have a software which is reliable, which is lag free and which processes the order on time. And those kind of softwares come at a cost. You would want to be having good softwares if you're trading with slightly higher amount of capital, and which is where software cost is also a cost which has to be kept in mind while taking any trading activity. The next is live data cost. Now this is important. If you're taking any data from free sources, they generally have data which have lag of 10 to 15 minutes and which is not acceptable if you're a swing trader. You would want live data, and live data comes at its own cost. So that is also one factor which you need to consider while doing trading activity. Historical data cost. Now history normally has a long or a very important factor in predicting the future. So if you want to do historical analysis of any shares or index or about 50, 60, 70 shares which you are tracking, then that data also comes at a cost. You need to buy that data from the market, from people who are keeping records of that, or from the companies who keep a record of that, and pay a cost to be able to use that data. So these are the important other expenses which we should keep in mind. The first is slippage, taxation, software cost, live data cost, and historical data cost. Now the next important point which actually gets asked often is that, should I be trading penny stocks if I'm doing swing trading? If I have to keep so much factors to be kept in mind, do I need to actually be risking my money in penny stocks? Now this actually question has no direct answer. It again depends on a risk profile, but one thing which I'll tell you, penny stocks do have a potential to give you exponential return. If supposedly you have bought certain stock at 5 rupees, it could be trading at 30, 40, 50 rupees in a year's time, or could be trading at that kind of money in 2 months time itself. That is exponential return. But that 5 rupees can be completely wiped off also. That company might get delisted, the company might go bankrupt, your share might be 5 paisa, 10 paisa share. So you're practically getting nothing out of it. So that is one risk which you should be able to consider while trading penny stocks. If you're able to take that kind of risk, go ahead and trade it. But as a personal advice, if you're willing to trade that risky stocks, use only 5 to 10% of your capital. So if you lose that capital also, you don't bear the brunt of it. So if you're an experienced trader, trade penny stocks but in small capital. But if you're a new trader, don't get exposed to penny stocks. First build your confidence, first build your trading style, first have sufficient experience, have sufficient capital, and then jump into the world of penny stocks. Now, what is the importance of stop loss? It's all understood that I have to take a swing trade, buy here, sell here. But how important is it for me to keep a stop loss for my trade while specifically doing swing trading? So this topic is actually generally not talked much about. Everyone talks about profit, buy at 10, sell at 120, buy at 10, sell at 12, buy at 10, sell at 15. But no one tells you what should be my stop loss, at what point I should say I've lost enough, let me get out of it. We'll try to understand that. So to consider stop loss, risk to reward factor is very important. For starters, never take a trade which has risk to reward ratio worse than 1:1. That is actually also a bad risk to reward. But that's a minimum risk to reward to be looked into while taking a trade. And always look out for stop losses which actually, if breached, means your trade has gone wrong. You shouldn't be stopped out just because you couldn't handle the heat and then the market goes in your favor. So look out for those stop losses which, if triggered, would mean your trade has gone wrong. Even if that means you go initially with a smaller size, because if you're trading a bigger size, then you got to have slightly more tighter stop loss. But if you're trading a slightly smaller size, you could have a slightly conservative stop loss, which if triggered, you would know that the trade has completely gone wrong and your views are absolutely wrong. So trade a size which is slightly smaller than what you can actually trade. So you have a slightly bigger stop losses, and if that is triggered, you know that your trade has gone wrong. So that is the theory or logic behind stop loss while trading swing trading. Now, what are the key takeaways or learnings from this chapter? We have actually gone in elaborate to understand the concept of swing trading. We learned that swing trading is generally done to express your views which is against the current trend in the market. I'll tell you how. If the market is in a parallel zone or within a zone of sideways movement, if the market is going up, so there's a good chance that the market will break out. But to take a swing trade, you'll be taking opposite position to capture the whole move on the downside. So that is what I mean. You're taking a trade which is against the ongoing trend or which is against the short-term trend in the market. The idea here is to capture one swing. You don't want to be holding onto a trade once the trade has gone in favor. Once the swing is complete, get out of the market. We also learned about as to how does one choose stocks for swing trading purpose. What are the criteria? What are the different factors? We have understood each and every of those factors in this webinar when understanding swing trading. We also covered 3 simple and effective strategies of swing trading. We talked about 3 strategies and we understood in length and with examples as to how does one apply these strategies, how does one spot these strategies in the market. And we also got a brief idea about the capital requirement and the other expenses we incur while doing swing trading. And we also touched upon the concept of stop losses, which is the most important factor while doing swing trading. And we have discussed in length about the concept of risk to reward. Don't take trades which are against risk to reward philosophy of yours, because if gone wrong, it takes double the effort to cover that kind of money. Now, having understood this bit, let us understand how do I spot swing trades on a live market, because the examples which I have given you are captured screens. But now we'll go to a real live screen and try to see if we can spot some swing trading opportunities which could have been taken advantage of. So we have got a list of 3 shares which I'll be talking about. I'm talking about Titan Industries, ITC and Pidilite. First of all, we look at the shares of Titan Industries. Now, I've drawn a 50 period exponential moving average and we're trying to see if there are any swing movements in the market. Now, if you look at the center of the screen initially only, I'm seeing that the market once gone above the 50 period exponential moving average, it started trending in that direction, which means every time the market dipped to that moving average, it gave you an opportunity to buy. And this whole zone lasted for a period of about 8 to 9 months. So that is the power of swing trading. Once the market starts trending in one direction, use the exponential moving average as a swing phenomenon If the market doesn't break the previous low, just comes around that level, gets supported around the 50 period, goes up again, it gives you a lot of buying opportunities. Let's scroll a little more towards the previous historical data. We are trying to find out again where the swing opportunities lie. Now this is again a classical example. This zone lasted from November 2018 to July 2019. So it was again 8 months. The market was again trending. It trended from 900 rupees to 1300 rupees. Within those 7 months, almost a 50% move. We are not talking about capturing the whole move. The idea is to capture that swing trade which it gave you. The market traded above the moving average, as and when it came to moving average, gave you buying opportunities. You would have lost money in one of the trades, but you would have made money in almost 4 trades. Once you're following any rules, don't skip a trade in between, because that could be a profit making trade also. Take all the trades within that rules and then judge at the end. Okay, if I got right in 4, I got wrong in 2, okay, that's a decent risk to reward. You would have made some money out of it. The second example which I'll be taking is for ITC Limited. Now we are trying to find the zone of swing highs and swing lows. I have actually not seen this chart before, so let's find the trades together on this chart. Now we'll be scrolling towards the left hand side and see what could have been a good swing trade in the market. Now we are trying to find out what could have been a swing trading opportunities on the charts of ITC Limited. Now this is actually a classic pattern, which is where the swing zone happened, and this zone lasted for almost a year, This happened about a couple of years back. If you look at the chart where my cursor is drawn, this is actually kind of swing high, and the swing low is about 250, the swing high is about 290. The market stayed in that zone for almost a year for 40 rupees, and it actually, whenever it came near the upper side, it gave you selling opportunities. Whenever it came near the level of support around 250, it gave you buying opportunities, and the market gave you a return of about 5 to 8% over a period of month and a half, which is actually a decent return. So swing trading opportunities are available in a tighter market, in a trending market also. Let us try one more chart. We're trying to see the chart of Pidilite Industries, and we'll try to spot some few more swing trading opportunities. And if we go scroll towards the left hand side, I see a swing trading opportunity right in the center of the screen itself. We'll zoom in a bit more and try to see the range. Now this is the range within which the market traded for quite a considerable period of time. I'm talking about the time from like May 2015 to almost Feb 2016, which means almost 10 months. And the swing zone within which the market trade was 600 on the upside, and on the lower side the market traded on 520 rupees, which means it was a 20% zone within which the market traded. You can't find exact trades in the market. There is bound to be slightly exaggerated moves on certain candles, so you have to be careful with that, because you might get stopped out sometime, and which is absolutely fine. So you got almost 1, 2, 3, 4 opportunities of buying or selling, and out of which 1 gave you loss, which means again 75% of the times you would have made money out of it. So that is a simple crux or way of spotting a trading opportunity. We have just taken 5 minutes and we have spotted 3 opportunities on 3 different shares. Imagine if you do a careful research analysis over a period of time, the kind of opportunities which could be easily spotting in the market. So that is it from us in this webinar of understanding swing trading, its various phases, its strategies. We have understood the importance of swing trading, how do you spot it, advantages, disadvantages, capital requirement, other expenses, importance of stop losses in swing trading. Plus we took 3 demos on the charts of ITC, Pidilite and Tata Industries. I hope you got a decent understanding of swing trading. If you have any more questions, doubts, please shoot us. We'll be more than glad to answer all of them. I thank you for your patient hearing. I'll again see you in future webinars. Thank you so much.